Hey everybody, Courtney Smith here with our weekly TradeSmith newsletter for April the 11th. A lot of interesting stuff. Of course, this is the best part of the whole presentation right here, so please pay close attention to it. Wow, things are working exactly as predicted. You can see that squiggly resistance zone. That's really capping the advance of the market as we looked for, and it's happening in all the three major indices. And so we got up into that resistance zone, and we've been chopping sideways, actually going a little bit down. I think we're going to continue to move lower over the near term, and that this resistance zone is going to be very, very difficult to break through. And so as a result, this is not an environment for us to get aggressive. Let's take a look at the Dow Jones. Same thing, pretty much exactly the same chart. Got up into the resistance zone and then peeled off. And I look for it to continue to peel off. Let's take a look at the NASDAQ in a little bit more detail because it's lagging and I think it's going to continue to lag. Let's take a look. Top two red bars. The top bar is pointing up, showing that prices actually were rallying last week. We even made new highs on the move while the S&P and Dow were actually sliding lower. But I've put a second bar. The second from the top bar is the green RSI, which shows that we made a higher high on the stock price, but not a higher high on the RSI. That's a daily RSI divergence and suggests that we will move lower this week. Right underneath it, I put another downward arrow showing the same kind of divergence with the on-balance volume. Higher high on the price, but not on the on-balance volume, also suggesting lower prices this week. And finally, I put an arrow pointing to the on-balance volume, the purple line, showing that it's lagging way behind the NASDAQ. It should be on top of the NASDAQ, or hopefully above. But this is also a bearish feature for the NASDAQ. So look for the NASDAQ to be the weakest of the three major indices, and for it to head down this week. Seasonality, still strong. You can see we weakened here on the IWM, the Russell 2000, but I'm going to still stay on a buy signal unless we break below that green bar at about 104.50. Don't expect that to happen this week, so I think we're going to still stay on a buy seasonality. Seasonality still chugging higher, still got to love it for at least until we get into May. Then we're going to have some problems. Momentum. All right, now this is once again the NASDAQ. Look how the momentum, I've drawn a red line on there. Notice how we were bouncing up really strongly back in February, and we're just really running out of gas right now. Yield curve should be quite bullish for us over the near term, but we'll have to take a look at that as we go along. Asset allocation, they're starting to take money out of the stock market. This is a big reason why I think we're capping the stock market movement, why we're just not going to move much higher at all. At least for the near term, we're going to chop sideways. This is showing that money's flowing out of the stock market and into the bond market, where I'm getting much more bullish. We'll get to there in a second. Risk appetite also. I talked about how it's running out of gas on the upside. Well, now it's cracked to the downside. So what's happening is that there's a shift out of risky stocks, such as the NASDAQ or Russell 2000, and we're going back into that state that we were at through January and February when people were just running for the hills. You fully paid up members. I'm going to show you another chart that supports this thesis when we get to your section. Global shares actually starting to show a little bit of strength here. They're starting to outperform the U.S. stock market here. You can see we've started to get a little mini rally there. Japanese stocks, interesting. You can see we collapsed down a week or so and then gapped up. But the on-balance volume, the purple line, is very, very weak. So I don't think that the Japanese stocks are going to do very well. One bullish feature, though, was we saw that heavy volume down at the bottom there on an up day. So, you know what? I'm getting conflicting indicators, and when I get conflicting indicators, the best thing is to simply stand aside. Now, over in Spain, going down, we did get a sharp rally on Friday on heavy volume, but at this point, my thesis about the European shares is not holding true. Except, look at how the UK shares are holding up. I'm getting pretty interested in buying the United Kingdom shares. Not quite yet, but this is the best one of the bunch. Except for the Greek shares. The Greek shares are not going down. They've been going into a rectangle formation. Now, a rectangle formation is usually broken in the direction of the previous trend. The previous trend was up. So I think that, buying a break to new highs would be a great strategy right here in the Greek shares. They've already surprised everybody with a 50% increase from the lows. We're going to get another 50% increase before the end of the year. Bonds, I talked about them before, and we talked for a number of weeks about how the technicals had become very, very bullish. Well, guess what? Now the fundamentals are too. Now we've got two of our indicators, the 10-year Treasury from Germany and the CRB, are both pointing down, meaning that we expect to see lower interest rates, which would mean higher prices. My objective here is up around 134, 135. Only one indicator, gold, is pointing higher for higher interest rates. So look for a sluggish bull market. Look for it to cap out at that 134 to 135 area. But bonds going higher, yields going lower for the near term. The dollar, whoa, still going down. Now, we might get some type of a rally here because notice we're bouncing across the bottom of this down channel, and that sometimes leads to a rally. In addition, look at the green line. That's the RSI, and we made new lows on the price, but not on the RSI, so that also suggests we're going to see the dollar higher this week. Now, combine that, suggests that maybe gold will slip lower. However, we talked last week about the flag formation. We broke through the flag. The volume was a little bit higher than normal. That's that orange arrow down at the bottom. Not really all that great. So it might be a bull trap. In other words, it's going to poke its head up above resistance and then start to go down. The volume, which is the green bar down at the bottom, is still going down, which still would suggest that we're in a flag formation. But we've broken out of the top, so it's kind of a mixed bag here. But if the dollar's going to rally, then that means that gold will probably go back down into that flag formation. So right now, this is not a pretty picture, not a bad picture, but not a pretty picture for the gold market from a technical perspective. But, and here's just another look at it here. But what I wanted to show you here is that we're starting to see that black line up at the top. That's the GDX, and that's the stocks. That's the gold stocks. And they made a new higher high. They've exploded to multi-year highs, whereas gold is starting to lag here. So looks like where we want to be is we want to be long the gold stocks. Here's why. Our indicators are turning bullish. Our top indicator, which is the euro, solidly bullish. The middle indicator, I'm putting that it kind of hooked up, and the bottom indicator was solidly higher. Now, if the dollar gets stronger, as I expect, low confidence expect, let's put it that way, then we may see the advance in gold blunted. But gold shares, I think, is the place to put your attention. They're going to hold up much better than gold. And here we can see the underlying fundamentals for gold are still bullish. Oil popped through the down channel, through the little flag formation there on heavy volume. So this suggests we're going to go up and probably get back up to 43.5 would be my first objective. Somewhere in that area, 43 to 44, let's call it that. All right, thanks very much, all you freebies. Love having you around. But, of course, we'd love you even more if you were a subscriber. Just go to that website up at the top, bit.ly/weekly market forecast. And you got to put the capital W, capital M, and capital F. And then subscribe. It's less than a Starbucks coffee every day. And this, the Starbucks coffee, that's just a money-losing trade. But if you subscribe to the weekly market forecast, you got a shot at making money. You can't do that at Starbucks. So anyway, thanks very much, everybody. All you fully paid up members, hang on. Some really interesting things are happening.